being not like to believe that I'm not a closed-minded person, sort of, said, okay, tell me about, what you're doing and how, how
Wow,
you do it.
that dragon
And
just
sort of,
breathed
I
fire.
got to better
How are you
understand what the
planning to
rationale
dodge
behind
that
technical analysis
and
is, that
counterattack?
it's not just a matter of trying to, look at pictures and it's not a black magic art. It's really, the philosophical concept behind technical analysis, nothing more. Then prices reflect the behavior of all the participants, and so the influences on the market. So therefore, there is a logical reason to believe that charts might be helpful. In any case, he was my influence, and after spending up to that point maybe 5, 6, 7 years purely as a fundamental analyst, and discovering that fundamental analysis, while it works for some people, it never worked well for me, because even when you got even when it was helpful and it gave you the basic idea of whether it's a bull or bear market, it did nothing for timing. I mean, that's one problem. Fundamental tells you nothing about timing. And the other problem is fundamentals sort of have how should I best put this, almost pathological relationship with risk management, in that if you have a fundamental opinion and the facts and the fundamentals don't change, the more wrong you are, the more the fundamentals dictate that you should increase your position, which is the exact antithesis of what you should do from risk management. Whereas, because to explain that a little more, let's say if I decide that wheat is a good buy at $5, if it goes down to $4, then it's a better buy. So if nothing has changed, right? So I should buy more. So the trouble with fundamental analysis, it has no risk management inherent in it, and on the contrary, it has the opposite of risk management. It would cause you to increase your position when you're losing. But technical analysis, by its very nature, if the market goes against you, unless you're one of those rare technical people who are using a counter trend approach. But with that exception, for the most part, virtually any methodology using technical analysis, if the market's going to go against you, the methodology itself would dictate you're getting out. So that was a big advantage as far as trading goes. And when I became familiar with technical analysis, I basically abandoned fundamental analysis as a way of trying to trade, and any trading I subsequently did was always technical oriented, whether it was discretionary chart reading or whether it was systematic, but it was always technical rather than fundamental.
Sure, okay. Thanks for expanding on that, Jack. Now, you've written over 10 books in the time frame of about 30 years, so it's clear you have an undeniable passion and a fascination for markets. But what was it that sparked this? And more so, what is it that continues to intrigue you about markets?
You mean an interest in markets, basically?
Essentially, yeah.
Well, when I got out of graduate school, I was basically looking for an analytical job that was not repetitive. And I guess you really can't get into anything more non-repetitive than markets, because it's always changing. And so it was an interesting way to combine analysis and a subject of study that was always challenging and always changing. So I think that's what's interesting about it. It's also a place where your opinions are, you get your grades pretty instantaneously. I should be clear, though, and I know your podcast is really a trading podcast. I got to be honest, even though I am probably considered one of the experts, certainly in terms of picking the minds of traders and trading advice, and I do think that what I've written in terms of trading advice is very sound stuff, and I've had so many people tell me it's helped them that I kind of believe that it's true. But having said that, I myself do not really consider myself a trader. I'm not particularly talented as a trader. I don't particularly have any grand emotion or passion for trading itself. I do it, sometimes I don't. It's on and off thing. Sometimes I do it, sometimes I don't. I don't particularly like the emotionalism of trading, which is one of the reasons I don't do it all the time. And also, it's a time eater. If you're trading, then it keeps you from doing other things. And so for time reasons, many times I don't trade. But for large parts of my
Yeah, well, I mean, that makes sense. So, I mean, let's talk a little bit about some of the books you've authored and some of the things you've learned and been able to extract from the minds of these insanely successful traders. So, I mean, first of all, what inspired you, or where'd the idea come from to write your very first book, A Complete Guide to the Futures Markets? I mean, what was it about?
Oh, it's very good. You're one of the rare interviewers that finishes that question with A Complete Guide to the Futures Markets. Usually the question is finished with Market Wizards, and I have to backstep and say, that really wasn't my first book. So The Complete Guide to the Futures Markets, it's going to sound egotistical when I say this, but when I got into the futures research, I kind of was impressed with the lack of quality stuff out there. And I didn't particularly think that I was great, but I thought that I could do better than anything that was out there. So I didn't find what I considered a really good book on the futures markets, and I thought that I could write a better one. And circumstances worked out that I was leaving a job, and I had no problem going and just finding another job. But I decided, I wanted to write this book. Why not take the time now? So I took a sabbatical. And so what I was trying to write was a comprehensive text on futures, sort of the definitive text on futures, at least for that time. It was a serious work. So, I mean, it runs over 700 pages. It covers all sorts of stuff in fundamental analysis. It covers statistical stuff. It covers all sorts of classical chart analysis. It covers technical indicators. It covers trading systems, testing trading systems, trading. Yeah, it's pretty comprehensive. So that's the book. And I did that, again, pre-PC days, pre-computer. I was literally, for those who do stats, you can appreciate this maybe, but I had to resort to doing multiple regressions using a calculator, which is just a great time waster. But it would have been a lot easier to do the book in modern times than it was when I did it. And it was only because I was so enormously focused at that time that I was able to even do it in a year. I also had to hand do the charts, everything. There was no Excel. There was no, or maybe I don't know if there was Excel or Word or any of those things existed, but this is 83, 84. If it existed, I didn't know about it, and I didn't have a PC, and I guess PCs were still probably in their infancy at that point. So in any case, that was a really a book that required manual labor. And that was the first book that I did. Now, having done that, I really didn't have a great eagerness to do another book quickly, but I did along the way, as I was involved in trading, and I knew some great traders like Michael Marcus and some other people. I was at that Commodities Corp actually for a year. I knew Bruce Kovner, and I knew some other people who were great traders. I thought, would be an interesting book to write, going to interview like these great traders and find out what they do and what do they do that's different and why do they excel where so many fail. But I had a full-time job more than full-time job as a director of futures research, and I wasn't eager to sort of work nights and weekends additionally on a book. So I didn't do anything for a couple of years, even though I had the idea. And then one day I got invited by a publisher to have lunch, and they said basically the pitch was, we think your Complete Guide's a great book. We'd like you to, we have this idea for a whole series of analytical books. We want to do one on each market, and we need an editor-in-chief, and we want you to head up the project. And sort of having done one of those very, very in-depth analytical books, which, by the way, you only do because you're trying to prove something, and you're trying to prove that you can do a really good book, or just for ego almost, or for self-satisfaction, or to demonstrate, or to just achieve putting out a really good book. But you certainly don't care, or you're certainly not focused on selling because, and I say this only semi-facetiously, it really is true as well. that the amount of books you sell are inversely proportional to the number of equations you put in a book. And by virtue, and I knew I'd put more equations in than I should put into that book if I wanted to sell a lot of copies. So maximizing sales was never my goal on the complete guide. It was basically to the best book I could that was serious and analytical and could be read by a serious layman. I think it doesn't require really a college degree in math or science necessarily to understand, but you have to be serious. That I only wanted to do once, and the last thing I wanted to do was to do it again. So I said, I'm not really interested in that project, but, because I don't want to do a bunch of books that sell very few copies and require a lot of in-depth work. So I said, I have this idea, which is I viewed more as a mass audience book and more of a book that, could reach, just a broader audience and be more entertaining to read and so forth. And I told them about the market wizard concept, and they really liked it. So I wasn't intending to do the book, but they came back with an offer, and sort of that was the catalyst. And that's how Market Wizards got written the first time.
Okay, that's really interesting. It's good to sort of know where the idea for that book came from. And I'd like to quote the opening line from the new Market Wizards, which is the second one in the series, where you said, "The markets are not random." And you made it very clear that this is a statement that you truly believe. But to what extent are the markets not random?
Well, to the extent that they're not random in a couple of ways. And this goes into the whole controversy, which has been going on for decades, between those who believe in the efficient market hypothesis and those who don't. The latter being, at least in serious academia, being behavioral economists. But of course, originally and now as well, the whole sorts of people in a trading community. Now, I felt from the beginning that concept was wrong for many reasons, but two big conceptual reasons. One is I just knew too many people who had obvious trading skill. And it wasn't just they were lucky, they just did too many trades for too long and had results that were too lopsided to be explained in a probabilistic sense that, if you have enough traders, some will get those results. No, I don't care how many, you can have 10 billion traders, you're not going to get those results, So clearly something is going on here where people are getting types of track records that from a simple probability calculation would be impossible if the markets were random. And that's one of the arguments I always have against the efficient market hypothesis. The second thing is, and this big, in both of these are big areas and there's kind of sub parts to them, but the second big concept of why I think people are wrong when they believe the markets are efficient is because prices, very often there's circumstances where clearly the market price is not right. I mean, there's just tons of examples where you can show that to be the case, and there's by no stretch of the imagination can you say the market price is right. So I'll give you. In fact, I wrote a book. My next to last book, and it was a non-market wizard book called Market Sense and Nonsense. And in Market Sense and Nonsense, which I go through a whole bunch of. Each chapter deals with a different set of, different subject of misconceptions. One long chapter, probably I think the longest chapter in the book is debunking the efficient market hypothesis. And one of the things I do in there is I give a number of examples of just come on, in no sane world could this happen if the markets were efficient. And there's a lot of examples. So let's just go, let me take one. I mean, there's so many. So let's say take something like Countrywide. Countrywide, if you had to pick a company that was the worst of the worst, I mean, I don't know who I would pick, in this whole 2008 financial meltdown and companies that participated, they, in my mind, they should, the heads of these companies should have ended up in jail, but they walked away with hundreds of millions of dollars, unfortunately. But no one was worse than Countrywide. And Countrywide literally proved everything. You could not, their people were instructed to give mortgages. If they turned down a mortgage for any reason, like just because a person didn't have a job or income or anything else and was asking for a large amount of money, they would be told to find a way to do it. And that was because Countrywide then sold off they didn't have to keep it. They didn't have to worry about people repaying. They sold it off to Wall Street, who didn't care because they repackaged them and sold them off to investors who didn't know any better. Or I should say, not who didn't know any better, who were relying on the rating agencies, who were either themselves incredibly dumb or compromised and looked the other way and then therefore are guilty in that sense. But they can only plead either stupidity or malfeasance. There's really no other way of explaining it. But in any case, going back to the origin type of company, the ones who produced these really, truly terrible mortgages that just had a very, very poor chance of being repaid, and did so knowingly and had a corporate culture where negligence was encouraged. Nobody, I think, could be worse than Countrywide. And that now, I just try to get people a sense of how bad this company was. So now a company like Countrywide was depending totally on this housing bubble going on. Because as long as the housing bubble goes on, prices are going up, and no matter how incapable people are of paying back a mortgage that you give the mortgage to, as long as housing prices go up more than they have to pay back, it kind of sort of self-sustains. Yet if that stops, a company like Countrywide is going to be in a whole bunch of trouble, right? Not only did it stop, but you can look at something like delinquencies. And delinquencies were sort of, during the housing bubble, were very low at about 5%. And then they start going up, and they go up and they go up, and they went from 5% to 10%. So mortgage delinquencies actually doubled. Now, this should have been like, mortgage delinquencies going up is the type of thing that should be a screaming cautionary note, for Countrywide being subject to collapse. And if you look at the chart, and this is why I say, if you tell me the market price is right, you got to be just blind. And I'm just mentioning, I'm going through detail in one example, but there's tons of cases like this. So what did Countrywide stock do? As delinquencies went double from 5 to 10%, it actually went up to a new record high. The record high occurred after delinquencies had doubled, and about a month after the record high, the stock collapsed. It didn't stop collapsing until it went out, until the company went out of business. So how could you can't explain that by the market price being right? No, what was going on was there was a bubble. People were just buying. People were buying without real insight. And there was enough dumb money that was willing to go into the stock because it was making new highs, even though it was completely rotten to the core. And the thing that was vulnerable was already blasted out because these are reported statistics. Mortgage delinquencies are reported data. So it's no big surprise. And so the collapse of the stock occurred about a year and a half after it should have. And it occurred right after it made a new high. So that's one kind of example. So my point here is that market prices are not always right. And if market prices can be dead wrong, and you can show many examples where they are, then the idea that underlies the efficient market hypothesis, that market prices are always right and all new information is immediately discounted, doesn't hold water because if market prices are not right, the whole theory falls apart. The one place the efficient market hypothesis is correct, and the reason why there's an illusion that it's correct, is because one of the conclusions that come out of the efficient market hypothesis is that the markets would be very difficult to beat. And that is true. The markets are indeed very difficult to beat, but not because the markets are efficient. They're very difficult to beat because what moves markets are both fundamentals and human emotion. And human emotion is very difficult to gauge. I mean, how far does a bubble go? When does the bubble break? These things are very hard to predict and very hard to trade. So it's not because the markets are efficient that the markets are difficult to beat. It's because there's such a big influence of human emotion that can't really be programmed to exist precisely and is very difficult to gauge. And so there's this conclusion by people who look at the market and say, oh, the mutual fund managers always, usually lose to the indexes, and markets are really difficult to beat. Therefore, the market are efficient. Well, no, that's not why they're efficient. Yes, markets are difficult to beat, but that does not mean they're efficient. In fact, one of the things I put into Market Sense and Nonsense was that line of thinking actually, it violates a basic rule of logic. So there's a rule of logic that says the converse of a true statement is not necessarily true. So let me explain that with a simple analogy. A true statement is all polar bears are white mammals. That's a true statement. All polar bears are white mammals. However, flip it around, all white mammals are not polar bears. The converse is not true. Like you could have a snowshoe hare. So the thinking that because something is true, if A is true, then B is true, then going to say that B is true, therefore A is true, that's a flaw in logic. And it's done all the time by many people who are arguing the efficient market hypothesis. It's just a straight out flaw in logic. And so what they're saying is, if the markets are efficient, then the markets will be difficult to beat, and then give you all these examples of how the markets are difficult to beat, which I totally agree. Yes, the markets are extremely difficult to beat. And then they jump from that back to the markets are efficient. It's a flaw in logic. And I can go on, but I think I've killed it. Oh, there's one, I got to throw out one, which is it's one example which is so beautiful. It's a recent one I came across, and I went to see Richard Thaler, who's one of the pioneers, and maybe the pioneer of behavioral economics, and a long time disbeliever in the efficient market hypothesis. And he threw out this one example, which I just thought was brilliant. There's a closed-end mutual fund that has the ticker symbol CUBA, Cuba. Now, what it does is it has a portfolio of stocks that are invested in Latin America, South America, not Cuba, by the way, but it does have that, because I guess it's a catchy symbol, CUBA. So that's what the closed-end mutual fund is. And like most closed-end mutual funds, it was trading at about, it was trading at a discount. In this case, it was trading at about a 15% discount. Which means that since closed-end fund, you can't do it. But if you were able to liquidate the entire portfolio, you're paying 85 cents on the dollar for what the portfolio is worth. That was on as of a given day. The next day, it goes from a 15% discount to a 70% premium. Okay, in one day. This is like unbelievable. So what happened? What happened is President Obama indicated his normalized relationships with Cuba. Now, the wonderful thing about this example is they did not hold, first of all, it'd be illegal to hold any Cuban stocks, and they didn't hold any Cuban stock, companies or stocks or whatever. And secondly, there was nothing in Cuba to own. It didn't even exist. Cuba is a true communist country, and there are no stocks to own. So despite the fact there was nothing Cuban in the whole portfolio, it went from a 15% discount to a 70% premium in one day because President Obama took steps to normalize relations with Cuba. You can't make this stuff up. And yet there are people who argue the markets are efficient, to which I would say, give me a break.
All right. Well, thanks a lot for going into so much depth with that answer, Jack. That's really good.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So I'd like to sort of pull this back a little bit to maybe some of the really key lessons and things that you've learned over the years from speaking to the traders that you've interviewed for Market Wizards. So let me ask you, in the first two Market Wizard books, is there a noticeable change in trading styles of those featured in hedge fund Market Wizards?
No, actually, I don't think that's really much. There's not much of a distinction in that. Now, hedge fund Market Wizards came, I guess, at least almost 25 years, I should say, after maybe the first Market Wizards book. So it came much later, but it does include people who were around from much earlier. For example, in fact, it includes, of all the Market Wizard books, the fellow with the longest track record and the earliest, maybe the earliest trader of anybody I interviewed was Ed Thorpe. And he was in the Market Wizards, hedge fund Market Wizards. So although, of course, some of the people, if they're younger in hedge fund Market Wizards, then they are starting in a later era. But I don't think there's really that much of a difference. The only difference is perhaps that in the very first Market Wizards book, and maybe a little bit in the second, there is a larger preponderance of futures traders, perhaps because, and I mean by straight out sort of futures traders, as opposed to people using futures for more complex strategies. And that's simply because back in that day, those were the traders that really excelled, and there were great opportunities in futures, and things like trend following worked much better back in those days before people started using the approach a lot. And the early practitioners of system trading, like Ed Seykota, had these spectacular type of results, which I don't think you could duplicate nowadays. So that's, I guess, one difference between the early books and the latter books. But like in both in the early books and in the latter books, you had fundamental traders, you had technical traders, you had people who did both. You had system traders, you had discretionary traders, and you also had a large variety of approaches in any of the books. So I don't think there's a big demarcation really that one can draw from the early books versus the later books. And I should add on that one point. When the 25th year anniversary came up on the original Market Wizards, the publisher asked me to we want to do a new edition. So what I did is I actually wrote an additional chapter. So the volume that came out, I think was the Market Wizards that was re-released in 2012, has an extra chapter. And in that extra chapter, what I basically do is I go back and I say, what do I believe now about markets? And I have one chapter about all the key points. And I deliberately did not reread the original Market Wizards when I did it. But the point was that I thought that my views or my conclusions about what are the important elements of trading success really didn't change from when the first book was written. So that chapter really was probably more intended to make the point that not much has changed when you get down to the important facts.
Okay, sure. And just to elaborate on that, and you kind of touched on it there, as we're now in 2015, do you believe that the same opportunity still exists in today's markets as it did for traders featured in the original Market Wizards? Like, besides their trading approach, is there the same opportunity provided by the markets, or has it become much harder to succeed at trading?
I would say from a logical standpoint, and of course one would have to to give you a correct or absolute answer, you would need data from back then and data from now, neither of which I have. And I don't know of any studies that have ever been done on that. And I assume in all cases, the majority of people, well, by definition, the majority of people lose, but whether the majority is larger now than then, I don't know of any data that would allow that to be answered. However, from a logical standpoint, I would say I would be surprised if it was not more difficult today than it was then, for the simple reason that you have many, many more professionals in the market than you did then. And I think there's a certain amount of opportunity in the markets, and the smaller proportion of professionals, and by professionals, it doesn't have to mean people working for Wall Street firms. It simply means people who are dedicated to trading and are really good at it and make a living from it. But the larger the percentage of, and of course, those are the people who have skill in the markets, obviously, by definition. But the larger the proportion of those people versus the whole population of traders, the more difficult it becomes to trade. And in fact, I'm sure I have a line somewhere in one of my books, I don't remember where, or maybe I just use it in talks, I don't know. But the line is something like, you could take the 100 best traders in the world, whoever they might be, and you could say, okay, you could have this thought exercise and say, if those 100 traders were the only traders that were allowed to trade the markets, the one prediction I could make is that 80% of them would lose, roughly speaking. And that's simply because if they were the only ones that are trading, we know that there's certain transaction costs involved in trading. So the amount of money that's won has to be less than the amount of money that's lost. So if only the professional traders or the most skilled traders in the world could trade, by definition, a majority of them would have to lose. And that just makes the point very starkly. So it's obvious that if you go from a small proportion of traders as part of the trading population to a larger proportion, you get to a point where it becomes almost inevitable that even professional traders lose. So therefore, it is safe to conclude that the greater that proportion, the more difficult it is to beat the markets. And I certainly think there's a much larger percentage of professional traders today than there was, say, 30 years ago.
Yeah, okay. I mean, that's a really interesting concept and way of looking at it. So thanks for sharing that with us. I'd like to bring up the topic of failure, because this seems to be a common theme amongst many of the traders you've interviewed, where they have experienced failure in one way or another, and in some cases multiple times before actually sort of making it, so to say. So what's perhaps one of the most extreme cases of failure and recovery that comes to mind?
Wow, there's quite a few of them. There's a number of traders who blew up or nearly blew up, some who blew up multiple times in the Market Wizard books. I'm glad you picked that up, because that is a common occurrence, and from which I draw two conclusions before I go to some examples. But let me give you, the listeners, the two conclusions that I get out of that. One is that early failure, or even terrible failure, is not necessarily predictive of future outcome. It doesn't mean if you fail you're going to succeed either, but it does mean that if you have enough confidence, and just because you failed doesn't mean you're doomed to fail. There's plenty of people that I've interviewed who were disastrous in the early years and turned out incredible. That's point one. And the second point is, well, they did ultimately succeed because they didn't give up. So that is an element of excelling, is this spirit or the self-confidence that just doesn't give up. Now, as far as examples, I could give quite a number, but let's just take one. Michael Marcus, who I mentioned earlier, who was the trader whose job I took when he left to become a trader, and who became a phenomenal trader. But his early experiences in the markets, he sort of lost, he had a very little money to start out, lost that, then cashed in his father's the life insurance his father, who died at an early age, had left. It wasn't much, it was like $3,000 or whatever, but he lost that. And then he started trading and some more money, and then he kind of hit it, and he built up this small few $1,000 stake into 30,000. And I go through a whole story in the book. I won't go through it here. But he then borrowed some more money from his mother, who was, of not of very good means, barely got by. But he got so caught that he actually then lost all the money he had made, plus a part of her money. So that was his experience, and very few people would have kept on going beyond that. He did, though. And the way that story ends is he eventually did learn how to trade. He did get extremely, extremely good. He was talented. And he ended up going to Commodities Corp. They gave him a $30,000 account as a starting portfolio. And he eventually built that $30,000 account into $80 million over a dozen years. And he did that while they were taking out 20% of his profits annually for expenses. So one of the probably most successful traders of all time. And hard to find anybody who had a more disastrous beginning.
Yeah, that's an incredible story. That's really, really impressive. So let me ask you this. Do you believe that perhaps some of the traders you interviewed almost had some type of natural talent for trading? I mean, I don't know if that's the right word. Or would you say that it really is an even playing field and anyone could reach these insanely high levels of success with enough hard work and the right people around them?
Yeah, no, I would say with fairly strong confidence that not everyone could. For the same reason is not everyone's going to be able to, I don't care how hard you train, you're not going to run a professional marathon time, because most people don't have the body type that will make it possible. Now, can people run a marathon if they've never trained before? Yeah, if you're gonna train hard enough, you can eventually run a marathon successfully, maybe even at a decent time, but only a tiny percentage of people will ever run it at a world-class time. And that's just the way most people's bodies are not constructed to make that possible. Can most people become soloists with the New York Philharmonic, if they take up the violin and practice a lot? No, I don't care how much they practice. They may become competent. They may even become, good, but very, very few people will become world-class violinists just because it requires some sort of innate skill besides just dedication. But in all those cases, people can achieve proficiency and success, but not necessarily exceptional success. And that's what I'm saying. And I think the same, why should trading be any different? So I think people can become net profitable, maybe even decent traders, if they have enough devotion and if they have some skill, more than decent traders, but only a small percentage of people, I believe, have the innate makeup, whatever that may be, to become truly exceptional. And I don't think trading is different than any other profession in that regard.
Okay, sure. That's a really good point you make. So, I mean, it's obvious that all the traders you've interviewed over the years were doing extremely well. But even still, did you find that they were constantly looking for ways to improve their trading? Or did any of them ever strike you as having felt like they'd perhaps mastered the market and were really comfortable with their approach?
Well, I think they were comfortable with their approach, but I think most would always be looking or realistic about if things stop working to change. And there are some people who are pretty exceptional at going from one strategy to the other. Ed Thorpe is a great example, who started out by actually. His background is he had a PhD. We didn't get the PhD in physics because he never finished his thesis, but the reason he didn't finish because he decided he didn't know enough math and then ended up with a PhD in math and then never wrote his thesis in physics. So he was a real quant guy, but he got involved eventually in markets. He's famous. His fame in the world, by the way, is not markets. It's famous to the world because he wrote this book, Beat the Dealer. He figured out mathematically how you could win a blackjack, and he wrote this book that sold millions of copies. And and actually is the person who's responsible for casinos changing the way they handle blackjack, multiple decks, reshuffling, all of that, due to his book. But that's sort of a tangent. To go back to the markets, he decided the real place to make money was the markets. And he was the first one to figure out the mathematical equivalent of the Black-Scholes model, which he did quite a few years before the Black and Scholes published their famous paper. So for a number of years, he was trading options very successfully, probably the only person in the world who knew how to price them. So he was making massive amount of money with very, very, almost no drawdowns. Then he went on, but as the efficiency went out of that, he became involved in statistical arbitrage. He developed that. He developed convertible arbitrage. He developed various strategies going from one to the other as each strategy started to lose its edge as more people became familiar with the approach. So he's a perfect example of somebody who starts out with one strategy and goes through completely different strategies by adapting to the changing market conditions. So even within a single strategy, like statistical arbitrage, I'm not going to go into the details because it's too specific for this type of broadcast, but even within that strategy, he changed the way that strategy worked through several iterations as the markets were changing, each time making the strategy again have an edge. And that's in the interview. I think it's too detailed to go into in this podcast how he did that.
Yeah, and I mean that kind of raises a point which I've heard you talk about numerous times, and that is that most traders tend to come unstuck due to a lack of flexibility. Is that what you're getting at here?
Yeah, I mean that's a trait that probably the majority of traders don't have, and it is a trait that is essential for great traders, and that is the ability to be flexible in every way. And one example would be to be able to say, hey, this has been a great method, but it's just stopping working, and I've got to figure out what does work and why this is not working and change if it's not working. So that's a way of being flexible. Another way of being flexible is like one of the stories I have in Hedge Fund Market Wizards, a fellow by the name of Jamie May, who goes into a trade, he goes into one trade idea, and this is a guy who does very, very deep fundamental research and can spend months researching an idea and making sure he's got it all right. But he had this idea, say, a few years ago where China was going from being a net exporter of coal to a net importer after years, a whole history of being just a net exporter. And he saw this growth in China and could see that there was going to be a tremendous amount of shipping increases going on because of China's demand. And so he had this bright idea of getting long shipping stocks. But when he did the research, he discovered that that shipping had actually gone through a boom a couple of years earlier because of a commodity price boom. And there was a whole slew of ships that were coming on stream, tremendous bulge in supply that was coming on stream. So once he became a bit aware of that, he realized that the trade was not buying shipping companies, but being short. He doesn't actually go short because he's always trying to have asymmetric return risk. So he did that by buying long-term puts on shipping companies. And ironically, this big idea that he had, which he put on in exactly the reverse fashion, ended up being his best trade for the year. Again, flexibility. And of course, maybe the most important way of being flexible is when you're in a position and you decide that you're wrong. It's the ability to get out. And if you're really convinced you're wrong, great traders will not only get out, but will have no problem flipping their position completely around.
Yeah, okay. And I think this is probably a good segue into my next question, which is, are there any traders you've interviewed and that stand out who pretty much just broke all the rules and just did the complete opposite of what you're quote unquote supposed to do when it comes to trading?
One. You can take all the traders I ever viewed into my life, successful traders I interviewed in my life, in any of the books, and including ones I interviewed that didn't go into the books, but only one stands completely alone, completely removed from the whole crowd of other traders. And if there is to use a cliche, the exception that proves the rule, I don't know. But the fellow is a prop trader, stock trader by the name of Jimmy Baladimas. He is the last chapter of hedge fund market wizards. Now, I should explain how I found, well, let me tell you what Baldemus does. You remember like a couple of years ago where we had certain commodities going sort of vertical, like silver, which had been going straight up, and then it got to 30 and 40s, and even I think the low 50s. But if you remember what that move was when it was almost like going straight up vertically in those higher price levels, well, who is selling silver in that type of a market? Jimmy Baldemus. Or cotton, which had gone multiples of its prior record highs, with the last days of the rally being these straight up, like a cliff type of huge price moves. Who's selling that market? In that vertical ascent? That's Jimmy Baldemus. So he's taking trades where the markets are going berserk the other way, and he's stepping in and going short. That's the type of trading he does. Now, I kind of say my first line of that chapter was Jimmy Baldemus breaks all the rules. And one of my first lines in the concluding paragraph, concluding summary of that chapter is some variation of "don't try this at home." I mean, my point, I really don't want people to read that chapter and try to trade like Baldemus. And I do draw some aspects of his trading that do have applicability, but it's actually one particular aspect. But I want to make clear that I really don't want people to, by any stretch of imagination, think that this is something they should try. Because 999 out of 1,000 people will go broke doing this. By the way, if I was listening to this myself, and I heard somebody saying what I'm saying, said, "No, that can't be right. This guy couldn't be successful doing that. He's, these numbers can't be right, and he's going to blow up." Well, I don't know. I guess he theoretically could blow up, but as far as not being right, he's been sort of one of the best traders in his firm now for many, for, I don't know, 15 years plus. And the way I know, and he makes millions every year, or I guess maybe in a bad year he comes closer to breaking even, but he's made a large amount of money trading this way. And for those who are skeptical, wonder how can I believe this is true, particularly for a prop trader. And people who are familiar with prop firms know you can't get track records from a prop firm. There's just no way of doing it because they just won't give out their numbers. So how do I know that this is for real and he wasn't like pulling a fast one on me? My son got a job as his trading assistant. And one day speaking to him, he said, "Dad, you wouldn't believe this guy I'm working for." And of course, being in the company, knowing of his reputation, he knew, and he entered all his trades and he knew his numbers. And so he knew he was for real. And that's the only reason I was able to put that chapter in the book, because otherwise I would have said, "No, this can't be right. This guy this can't be true." I would not have believed it myself. But if I didn't have my own son for verification, I wouldn't have believed it either. So, but for those who are wondering how that could possibly be true, that's the answer.
Yeah, and I guess that kind of, even though you said don't try this at home, obviously for good reasons, I guess it kind of highlights a point I've heard you make in sort of given talks and other interviews about how it's so important to find your own trading method and not necessarily try and mimic exactly what someone else is doing.
Absolutely. Yeah, and that's actually, when I give talks myself, if there's any point I emphasize probably more than anything else, is what you just said, that don't look for the trading secret. There is no trading secret. Look for the trading method that's right for you, and it's not going to be the same for everybody. So that's absolutely true. And then Baldemus's approach would be wrong for almost everybody. Almost everybody. It's right for him because his nature is he just is not happy unless he's going against the crowd. He just always wants to be against the crowd. And if he tried trading another way, he probably wouldn't succeed because it's so against his nature. It's not a good way. He actually could. And in the interview, if people read that particular interview, they'll see I'm trying to say, hey, by the way, the reason he makes money trading against the markets that way is not because he necessarily is great at picking tops and bottoms. is because he's constantly trading against his position. So he's going short, the market comes back a little bit, he's buying it back. When he's buying, he would do like 300, 400, 500 trades a day, and he could be short like 500 stocks. But if some of them, whenever they did, he's short, if they dip a bit, he'll take partial or total profits and then put them back on. So he's constantly taking profits out of the market that way. So that's what's really making his money. And he succeeds even though he's against going to major trends. It seemed clear to me that if he did the exact same thing, just trading against the positions, but went with the trend instead of against the trend, he would be a lot better off. And I explicitly mentioned he never really argued it or could give any reason why that wouldn't be true, but it was just against his nature. He just had to be opposite the wave in the market. If there was a mania of any sort, he had to be against it.
Okay, sure. So, while we're on the topic of trading methods, you often hear people say, keep it simple, don't overcomplicate things, simple works best. So my question is, did you notice amongst any of the traders you've spoken with and who were doing extremely well in the scheme of things, that for the most part, they do have a very simple approach, or is there an aspect of complexity to their success?
I've seen both. That's a type of trade or factor that doesn't really, there is no proper one for this. Is a successful traders use simpler approaches, successful traders use complicated, but I've seen both. Again, going to something like Thorpe, his approaches were highly quantitative, highly complex, and it was their complexity, I believe, that not just the complexity for the sake of complexity, but complexity that was necessary. Well, so let me say that again: complexity that was necessary to tease out the edge that he found. Or people like D. Shaw, again, extremely complex approach. You're talking about trading virtually every market in the world, all sorts of derivatives, outright markets, all sorts of options, thousands and thousands of instruments, trading them all against each other with scores of models, with teams of hundreds of PhDs. You really can't get much more complicated. And it's the complexity. He's teasing out small. He's not actually actively participating anymore. He went off to pursue other endeavors, particularly computational biochemistry. But he designed this whole process, and he was basically finding a lot of very, very small edges, or that's what the approach does. And it would not succeed without complexity. So you have that as clear. You have those examples for clear situations where you couldn't really be successful without that necessary complexity. On the other hand, you have other traders who are not doing anything much more complicated than reading charts, but are particularly good at it, and use risk management and basically combine chart pattern recognition with risk management. Doesn't require a PhD. It does require skill to be able to tell which patterns are more likely to result in a move one way or the other, and it does require the skill to use the appropriate risk management. But having those two properties, it can then be executed without really any great complexity. So I think it ranges across the board.
Yeah, and I guess that just sort of comes back again and highlights your point about finding a trading method that that meshes with your personality. Now, something that is forever embedded into my memory after reading, especially the New Market Wizards, was the necessity of having an edge. So I'm interested to get your take on this. What exactly is an edge? How do you define it, and how do you know if you have one?
So first of all, there are people who misleadingly think that an edge is not absolutely necessary if you have good enough money management. There's in fact, there's a famous Wall Street saying that goes something like, even a poor system could make money with good money management. Now, that's absolutely one of the most ridiculous things that has ever been said. Besides not being true, it's just absolutely stupid. And the reasons it's stupid is for the same reason it would be stupid to think that you could go to Las Vegas and play roulette with a money management scheme and come out ahead. No, you can't come out ahead because the house has the edge, you have a negative edge. All you're going to do if you try to apply money management is to guarantee that you lose. In fact, actually, money management in a situation like that would be bet all your money one time because that's your highest probability of winning. So the best money management scheme is real betting it all at once, which is really the opposite of money management. So you can't be salvaged by money management. Now, the money management is absolutely essential, maybe more important than methodology, but it's not enough. You need to have an edge. So this gets down to, okay, so how do you know if you have an edge? Well, it's not one of those things you can look up or find a rule or prove absolutely. I guess you could see it in your equity if you show some consistency of making money without unduly large drawdowns. Then over time you can begin to conclude that you have an edge. If you are good at the markets, people who are good at the markets, another trait that does typify really good traders is they have a high level of confidence, and that high level of confidence is impossible to have unless you're delusional, unless you do have an edge. So it's a type of thing you have to sort of feel and believe on your own. It's not something that's definitively provable or anything like that. It's just that if you're in that groove and if you're kind of making money with some consistencies and have control of your losses, you get to the point where you feel that you have an edge, and your equity confirms that. I mean, you could feel that you have an edge and you're losing money, then you're delusional, So, but if your equity curve is reinforcing your what you're feeling and seeing and executing your approach, then you can jump to the conclusion that you do have an edge. But you need to have an edge, and an edge does not exist without a methodology. I've never met anybody who has an edge that doesn't have a very specific methodology.
Yeah, that's really well said, Jack. And just while we're on the subject, talk to us about one of your pet peeves, which you've labelled the well-chosen example. I really liked what you sort of said about this in one of your books. So would you mind explaining what is the well-chosen example and why should traders be aware of this?
Yeah, okay, that goes back to the very first time I wrote about that was back in Complete Guide to the Futures Markets, which was done in '84. And basically what I was seeing in the industry when I got into it was, you'd have all these ads for trading systems, right? And they would show you this trading system. They have a chart, and they would. There was like a perfect example would be like you would have a chart, and it was maybe a euro-dollar market or something like that, and the market would be you'd show all these sells and buys, and the sells would be all near the highs, and the buys would be all near the lows, and it looks like, oh wow, what an incredible system, and it could actually be an actual system that gave you those results, but in that particular case, it would be a counter trend system that you kind of, there was a market that kept on having false breakouts on both sides. And basically, if you use a system that sort of sold the breakouts instead of bought them, you did extremely well during that particular period of time. So you have a system that looks like it's really performing very well. But with that particular example, you use the same approach in a trending market, and you'd completely wipe out your account. And actually, the way, as I recall now that you mention it, I remember the thing that really drove this home. It was one day, we had been working on trading systems, and I had a partner that I was working with. And we developed these systems and spent some time on it and whatever. And I wouldn't say they were complicated, they weren't complex, but they were not super simple systems and had some sophistication to it. And then I read this article, and it showed an example of, I think it was a Swiss franc it was, and it showed it over a year or two time, and it made like $37,000 at very small drawdowns, and the signals were just great. And then I ran our system, and we did nowhere near as well. Yeah, our system made money during that period, but nowhere near as well. And I was kind of discouraged. And the system that was described, by the way, this was for a magazine article, right? It was a very simple system. It combined two moving averages. It sort of took something like a 20-day moving average and a 6-day moving average, and when they were both long, you were long, and when they were both short, you were short, and if they disagreed, you were neutral. And I kind of, knew that. Well, we had tests that said, one of the early things we did was test moving averages over, different time periods, and just as a basic, very simple approach. And I knew that, 20-day moving average low, 6-day moving averages did not work well. So how could the two of them work together where each one didn't work on its own? I knew that. So we ran the analysis, the exact same system, on a portfolio of maybe 30 markets. And here's what we found. No surprise. The one market it worked best on was the Swiss franc. And no surprise, the single year it worked best on was the year in the example. So the author had kind of found the one market for the 1 year where this particular approach worked best. Now, if you did the approach on a diversified portfolio, if I recall correctly, I think it lost money. But the one example looked phenomenal. And this happens all the time. People write books. They'll write books on charts and technical analysis and all this stuff, and they'll show you examples of how it worked. When I did the complete guide and when I did the follow-up years later, the Schwager on Future series, I went out of my way to choose examples where things didn't work. In fact, I had a big section of the book where I took trades I was recommending as a director of futures research, and I took a whole segment of trades that I'd recommended as they were, and some were winners and some were losers. And basically I didn't cherry pick. I just took them, and I didn't try to make the winners more or losers. I was just kind of demonstrating what were the right choices, what were the wrong choices. And I went out of my way to show things that didn't work. I went out of my way to actually point out when I did classical chart analysis that these patterns, well, it's good to know them, and it's good to know how they work more often than not, or how people expect them to work, or how you could theoretically use them, but also be clear that there's lots of times that they don't work out well. And in fact, what I call the most important rule in technical analysis is actually a failure rule. It's basically that when a chart pattern fails, that is a signal in itself, and it's a more important signal than when you get a chart pattern that seems to be confirmed. So I always spent a lot of time trying to make sure that people understood that don't just take anything because this example works. Don't jump to any conclusions. You always have to test everything on a broad portfolio over a broad number of years, but almost all books, almost all articles don't do that. They just take things that work, and they allow the reader to jump to the conclusion that this thing is really the best thing invented, and when it's really not.
Yeah, I'm really glad you sort of went into that in so much detail, Jack. I think it's a really important point. But let's move this along a little bit. So I'm keen to hear a bit more about what you're working on these days. I know you're keeping busy with Fund Seeder, as well as been working on some indicators with Trade Shark. But let's start with Fund Seeder. So give us an overview of what this is all about and how this platform is helping traders to improve.
Okay, so Fund Seeder, first of all, to give credit where credit is due, I'd like to say it was my idea. It wasn't my idea. It was an idea of a colleague, Manuel Bellari, who I work with on a different project. At the time he was with ADM Investor Services, and I was actually our relationship started when I was still with Fortune Asset Management, which was a hedge fund advisory firm that got acquired. But we continued to work together, and in terms of constructing portfolios, and I was an advisor for that project. And these are portfolios of hedge funds. In any case, one day Emmanuel said to me, we were at a conference, and he said, I've had this idea, tell me what you think of it. And he was the Fund Seeder concept. So this concept was, and what the Fund Seeder concept is to create a website, a web meeting place that would be the intermediary between undiscovered traders, primarily undiscovered, it doesn't have to be undiscovered trader, but traders, particularly undiscovered traders, and investors looking for trading talent. and they could meet at the website. You could also think of fundseeder.com as a search engine for trading talent. So that's the basic idea, and very critically part of that idea is that you just don't try to get traders to register with your site and put them on and get their numbers and post them. A very, very essential part of this concept is that you don't get the numbers from the traders, you get the numbers directly from the broker. So traders would register on the website and link their accounts to the website. So therefore, the numbers that would be collected on the website would be numbers coming directly from the brokers. So gives it much greater validity and sort of implicit verification in that process, vis-a-vis most sites which will just take numbers that are provided. So that was also an essential element. And to get traders to the website, the key is that you're going to provide this verified track record, and that will make it easier, much easier for traders who would have not a prayer in the world of attracting money, let alone institutional money, of being able to do so if they are trading talent. We in fact have, unbelievably, with the site still pretty early on, we're still in the early stages, but even at this point, we have literally traders registered from over 100 countries. I mean, I found that astounding. I think it's astounding enough there's traders in 100 countries, but the fact that we've already have that many different countries represented, and this is still very, very early on. We've only just recently expanded the site to go beyond the initial couple of brokers we were able to directly link with, a few brokers, and now we can link with virtually all major brokers. But that just happened. So this was even before that point. So you take traders in some developing countries, let's say, or some Eastern European countries, take a trader, I don't know, anywhere, it could be in the Ukraine or whatever, who has a math degree and develops a trading system that's really good. Is he going to have any chance of raising any money, institutional money? Not a chance in the world. But if he can get a small stake together and trade it and get a track record that's coming from the broker, he can build up a track record that can then be used to attract attention. So that's the basic concept. Now, so far we've only done the trader side of it. We had originally planned to have a trader and investor side together as one website. And for regulatory reasons, we decided to keep those separate. That we would right now, we're just in the process of building the trader side and getting attracting as many hopefully talented traders as we can worldwide to the site and building the track records and ultimately hoping to be the site people go to or that can be used to find trading talent. And at this point, there is no investor side because that's where our focus is. We will later this year construct the investor side of that as a separate site, which we will then populate with. We will use traders from the trader side as a source for the investor side. And the investor side will be through a registered company and which will have all the appropriate regulatory compliance met and so forth. So we're just taking care to do it that way. But as far as traders are concerned, while this site is not directly accessible by investors, there will be a one company that holds both sites, and if there's trading talent that shows up on the fundseeder.com, we're going to be using that site to find trading talent and hopefully in the future lead some of that trading talent or connect some of that trading talent with investors, primarily basically, or maybe only institutional type investors looking to allocate money to undiscovered traders. Oh, and I should add one thing. The site right now, there's a current platform that allows traders to do stuff that they really can't do on most normal platforms, like get an equity curve and do analysis on an equity curve. We are, however, that was basically the first platform we're using. We currently have under development we have a technology team doing a whole completely new platform that will have literally 20 different trading tools, including all sorts of graphics and analytics that one can perform on one's trading record, both the equity and trades themselves. And will allow stuff like besides just equity charts or even underwater charts or other, will allow charts, say rolling charts of let's say rolling return charts or rolling Sharpe ratio chart, or any metric you want to choose. We'll have tools that allow traders to create use technical tools, let's say like a crossover moving average, to apply to their equity curve, so they can signal when their equity curve is starting to trend down. So they could use that as a cautionary signal to maybe take a second look at their trading, or maybe cut back trading or stop trading or whatever. So we'll have Monte Carlo simulations, on and on and on. Now that new, much more comprehensive and much better graphics website will come on stream probably sometime in the fall. If people go to fundseeder.com and register, then anytime we do anything new, like we just did when we expanded the accessibility through almost all major brokers, which was a new thing. We did that just days ago. We put out a newsletter. So if you're registered and we have the new platform, you'll be notified of that. And traders now, as I say, almost no matter who their brokers are, can probably link to the site.
Okay, excellent. I mean, that sounds like a really good platform. Definitely can see how it's going to help a lot of traders out. One thing I've got to ask is, have you been surprised and maybe pleasantly shocked with some of the results and talent that have been produced by users of the site?
Well, it's too new to answer that question because, unfortunately, track records materialize in real time, and we're tracking from when. Now, in some cases, it depends. With some brokers, like Interactive Brokers, I think when they sign up from there, the backtracker gets imported, and we do have some good traders that are evident through that. But it depends on the broker. And for a lot of brokers, there's no past record that's imported, so it just gets built in real time from the point of the registration or the account linking. In some cases, a small amount of data, but for the most part, for most traders, we really have to wait for the track records to develop. Now, I wouldn't be surprised. One of the things I do anticipate is that we will find some really exceptional traders that are unknown to the world through this process by linking out on a global fashion. Like I say, once you go out, you're literally getting people from 100 plus countries. You're going to be looking at people that no one else has looked at before. And that combined with the idea that you only need a tiny, tiny fraction of all traders to be really good to have a substantial number of excellent traders. So I don't know how many traders there are. There's certainly many millions, maybe tens of millions across the world. Who knows? But you only need a tiny fraction of those, a fraction of 1% to be good, to really have a large number of good traders. So it doesn't have to be a large percentage. So I fully expect that we will have some really good traders come out of this process. And in fact, one of the things people will see if you go on the website is this thing called Market Wizard Search. What the Market Wizard Search is there's going to be some future book called Undiscovered Market Wizards, and that those undiscovered market wizards will come from traders we discover through this website. And a book ain't going to happen this year or next year. It's going to take a few years of kind of having this thing run, and but at some future point, when we feel we have, or I feel I have enough traders identified through the site who seem to have been able to perform for enough time with enough consistency, then there'll be this book called Undiscovered Market Wizards. So I'm expecting that to happen, and I would be surprised if we don't find enough traders to fill a book.
Very cool. I mean, that's definitely something to look forward to. So all the traders in that book you plan on sort of sourcing from Fundseeder.
That's the plan. That's the plan. I guess I shouldn't. If I find some unknown trader in a different way, I guess I wouldn't rule out that they would go. But my primary source for this book is going to be indeed the website. That's the plan. And, if I'm wrong, there wouldn't be a book, but I really have trouble believing that I won't find at least a volume of. I'm sure I'll find more than that. I think we will have more than enough people to be able to choose, a book's worth of what I call undiscovered market wizards.
Yeah, no doubt. I'm sure you will. I'm sure you'll definitely find some. So, let's just change topics and speak a little bit about on the Trade Shark front. I'm keen to hear about the indicators you've been working on there. So, tell us a little bit about maybe what Trade Shark is and the indicators you've been working on.
So Trade Shark is a chart software company, and not just because I did a project with them, but their chart software is really very good. You can tailor your charts very precisely the way you want them. Easy, it's intuitive. It's a very, very nice chart package and lots of indicators, and including quite a number of proprietary indicators. But that's a matter of people find what works for them and so forth. So I never endorse other indicators or anything else, because even my own I wouldn't say anything I don't make any guarantees about it. I can tell you what they are and all that. But so they had asked me to do this project. They wanted me to create some indicators, and they had two other people that had created, Larry Williams and I think Ralph Fintz had created some proprietary indicators for them. And they asked me if I would be willing to do that. And I said, I'll tell you the truth, I'm just not an indicator person. I actually don't use indicators myself, have not used them. And while I've worked on systems, trading systems, and I've done a fair amount of work on trading systems, I've really never done indicators. But I said, let me think about it. And I thought about it. What I actually ended up doing was I realized that the system work that I had done could actually be transformed into indicators. And so there was a project I had done way back, I guess it was at least over 25 years ago. And I had done it with my partner at the time, Louis Lukac, who was a real computer whiz, and he's always programmed everything I've done actually since the time we met. He's always been the fellow who's done all the footwork, all the programming, and all the hard work, And so anyway, we had developed when I was at Prudential, I had developed this in-house trading system, and we had come up with certain systems that we were putting out signals on and all of that. So the idea was to use those systems with different parameters, and those systems included both trend and some counter-trend approaches. And the idea was to create indicators that were composites of those, using different inputs, combining different systems, so to speak, into a single indicator. So there's one indicator that's called the trend weight. Well, the trend weight's really a composite of different systems, and there's also an overbought, oversold indicator, which is a composite of different counter trend systems. And there's one that's directional weight, which basically adds the two together. So if the market's trending, and the trend's sort of reaches a maximum reading and stays there for a while, or is very high readings, eventually the counter trend starts to build up, and at some point if the directional weight which combines the two could come back to zero, or even reverse direction, while the trend is still looks like it's running. So that's a third tool, and then there's something called a dual trend, which basically takes a trend weight and combines it with one of Trade Shark's own indicators, which is a much shorter term indicator. So my stuff tends to be more. The indicators are really, and I did a set of videos. The videos are available for free at tradeshark.com. You could find them. You could find the indicators. There's not the indicators, the videos. So the videos are for free, and you can look at them. So this is all explained. So there's one on each approach. And there's one called the dual trend, where the dual trend takes the trend weight, which is intended to capture long-term trends in the market. That's what it does really well. And it's good at staying with trends and all that. It has defects of any trend approach, which if you get a very choppy market, it is going to lose money. But on balance, over the years, the reason I took something for 25 years old, so we could test it for the past 25 years, I wanted to make sure that in the interim, it was something that had a significant edge in working versus, so that I could make at least confidently say that based upon 25 years plus empirical evidence, there's a much better chance going with it than against it. So it was important to be able to test something like that blind. That's why I wanted to use something that was developed a long time ago. In any case, that is combined with trade charts, another trade charting indicator, which is much shorter term, and that's called the dual trend. And I kind of like that because they're so different, and that the dual trend will change much more quickly. But it also won't be anywhere near as good in riding trends. And combining the two has nice properties. So that's a fourth approach. So there are these approaches. They're explained by the videos. They're more inclined towards a systematic approach to markets. And I also arranged them. One of the key things I did was to have them each have inputs that needed to be defined. So there's not just one fixed way to use it. You have to define a threshold conditions for each of these indicators. And there's also, you can choose something like an early exit, an early reversal, which are explained. And by doing that, you can turn these indicators into your own sort of approach, which is very important because I don't want to go counter to my own advice. I always tell people, don't just get a trading system and follow it. Don't buy somebody else's trading system and follow it, because the odds are you're not going to last, because as soon as it has a bad period, and every system has a bad period, you're going to abandon it because it's not yours. So I made these so that they can be combined, they can be used together, they can be used, you can vary each one. And so two different users can develop completely different signals off of the same indicators. And that was critical because one of the essential points is that users need to make these, to choose the parameters that go with these approaches so that they fit the way they are comfortable trading the markets. And when you do anything, one thing that's good about Trade Chart is that you can actually see, like, you could do stuff, which I do in the videos, is like anytime there's a buy signal, it's shaded green. Anytime there's a sell signal, it's shaded red. And it's neutral, it's, let's say, yellow as an example. Well, you can superimpose that on the price chart as a lightly shaded backgrounds, and you can pull in the data, let's say, the last 10 years, and then you can walk through 10 years of data using this particular approach and see exactly how the market did. It's not fitting it to what it did. You could see, had you done this 10 years ago, and theoretically you could have done this 10 years ago, again, because it's based upon stuff that was developed 25 years ago, how it would have performed in a real sense. And so users can get a real sense of what one particular adaptation of these indicators would actually work, and can experiment and see very visually where the buys and sells are coming in.
Yeah, yeah, good one. Well, I'll put a link to those videos in the show notes for this interview. And if you want to access the show notes, just go to chatwithtraders.com/27, and the links will be underneath the interview. But I mean, Jack, we should probably start to wrap things up because we've been going on for a little while now. But before we do this, one last question, and I'm sure you have a ton of great quotes and one-liners which you've picked up over the years, and it wouldn't be right to ask you what's your favorite, but is there just one or two quotes that you would like to leave us with before we wrap things up?
Okay, that's an interesting question. Okay, I'll give you two quotes. I'll give you one quote from one of the people I interviewed, and I'll give you one quote that's my own. Interview from the people I interviewed, and this is the quote. This is what I tell people. If someone said to me, Jack, we want you to give your best trading advice. We only got there's one kind of condition or constraint here. You can only use 10 words. So if I can only give advice in 10 words, right? And this is the quote I would use. And it's a quote from Bruce Kovner. And the quote is, know where you're getting out before you get in. The quote that I would use, and I guess I should just explain why that's so important. Well, for one thing, it sort of guarantees risk management. And for the other thing is, it's much more subtle. And that subtlety is, you're making a decision of where to get out of a trade before you get in, means that you can make that decision with the benefit of complete objectivity. Anybody who's been a trader will know that once you're in a position, you lose objectivity. So most people, almost everyone, will get into a position and worry about getting out at some later point. But once they're in a position, your thinking gets clouded. If you can decide that ahead of time, as Bruce Kovner suggests, then you're thinking from a much more objective and, I believe, a potentially successful frame of reference. As far as my quoting myself, there's a line I have, I'm sort of paraphrasing it, and it goes to this idea of finding your own approach to market. And the line is, there's a million ways to make money in the markets. Unfortunately, they're all very difficult to find. But there are a million ways. And the point is, don't worry about finding a one way. There are lots of different ways, but they're hard to find. But there are lots of ways, and only a very, very small number of types of ways are going to be right for you.
Yeah, both extremely great quotes, Jack. Thanks so much for sharing those, and thank you so much for coming on the show.
I appreciate that. You really did your homework on those questions, and you did a really extremely. I've done quite a number of interviews over the years, and you did a really good job on touching on a lot of different subjects, and clearly doing your homework. I appreciate that from your side, and I think the one drawback is that I think this podcast could end up so long that maybe you have to break it into two parts. I don't know, but whatever.
Yeah, no, that's great. But before, and thank you very much for that. I appreciate your feedback there. Before you go, do you want to share with listeners where they can go to find out more about you and stay in touch with what you're up to?
Right. Okay. So, again, the main site that the company that I'm involved in is funseeder.com. I also have Jack Schwager, myname.com, which I no longer update, but there's stuff up there. There's stuff up there. Interviews and articles and links to books and stuff like that. But the other site is funseeder.com. So those are the two sites I would direct people to.
Okay, good one. Well, I'll put links to everything we've mentioned during the interview, so your books. You're also on Twitter, aren't you? So I'll put your Twitter handle in the show notes. Yep, cool. And links to Funseeder, Trade Shark, and everything that's been mentioned. Just go to chatwithtraders.com/27 and you'll find everything there in the show notes. Again, Jack, thanks a lot for doing this. Take care and let's talk soon.
Oh, it was fun doing. Okay. Have a good one, Aaron.
Thanks, Jack.
Brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have...
Yeah, we'll get into some discussion about options and sort of systematic trading. And seeing as you're very clued up on options, where as I'm almost a complete novice in this area when it comes to options, but I mean, listeners will probably recall me saying that from previous episodes, but feel free to add to your answers with anything that may be valuable, even if I don't necessarily prompt you with my questions. So,
okay, sure.
I can do that. Plan?
Yeah, sounds great.
All right, cool. So let's start from the start. And if you don't mind, share with us, what were you doing before you got into trading, and then what actually sparked your interest in the markets?
Well, before I became a trader, I was a full-time commercial real estate broker in Florida. And when I was kind of developing my career there, and I was working on teams, and through unfortunate timing, my career was just starting to grow when the Great Recession hit, and Florida specifically was kind of the epicenter for the real estate crisis, where a lot of the United States real estate values dropped 10, 15, 20%, and in the area where I live, things dropped by closer to 50 and 60%. And so our local market went to more of a depression, whereas the rest of the country went into a recession. And at that time, so it was challenging, and it looked like it was going to be very difficult for several years. And one of my mentors that I've known ever since I was a teenager, he also had a lot of commercial real estate holdings, and we were involved in the business together. And we were discussing it, and he had some investments with a hedge fund that was trading options, and they were doing very well. And so we said, well, this is great. The market's going down, and they're profitable. It was totally counterintuitive, and we did not understand how that was working. How are these guys trading options, which is part of the stock market? They're trading S&P 500 options, and the market's crashing, and everything's bad, and the economy's going in the toilet, and these guys are making money, and they were making a lot of money. And we're like, we have to figure out what's going on. We have to know what's happening. And so we both kind of parallel went into this education process of kind of self-teaching and exploring what was going on. And so that was back in 2007, 2008. And we're going through that process and a lot of studying. And one thing led to another that I just decided that I didn't want to tie myself to a local economy. I didn't want to tie myself to one industry and one sector, and that by trading the markets, I was going to have the ability to be in any market that I wanted to be in and anywhere in the world, and I could do it from anywhere in the world, and that I could actually profit like these guys, whether the market went up or down. And I said, that's the path I need. I need to be on that path. I need to have that opportunity where I'm not dependent on a strong economy. I'm not dependent on economic growth for how I'm going to do each year. So that's kind of what spurred everything, and how I became attracted to the trading world. And then one thing led to another, and just through my natural instinct to network and work with traders and work with business contacts and really just get out there and not just live in a bubble. I got to know a lot of great people and got connected with SMB Capital in New York, and really was able to expand and get my trading up and running and go full time. Okay. That's kind of the background.
Right. Yeah, that's a really good answer. So let's get into that sort of education process, which you briefly touched on there. What was that like? Like, what was the process you went through, and what was that education that you were sort of absorbing right at the very beginning there?
Right. Everybody starts probably in a similar place where they're gonna absorb all the free information that's available. So there was lots of hours on YouTube and lots of time on blogs and social media and trying to find videos, and then you go buy the stack of books from Amazon and you get them and you start reading all of them, and that kind of orients you to what's going on in the lingo. But it really the unfortunate part of that is it can lead you down a challenging path, because you may start to learn the language of trading. You understand the concepts of what the different tools are and what the different instruments are, and maybe they talk about strategy, but they don't tell you what to do. They don't guide you, either from liability, or they just don't know what they're doing and they just know how to explain the market. They might just be a financial publisher and not really a trader. And so you don't really get the tool. You understand about it, but you don't understand what to do or how to do it. So it was kind of like a struggle. There's a lot of excitement about the possibilities, but really just not having any guidance made it kind of challenging. And then little by little, I realized, and then the other traders I work with realize this even quicker than me, is you have to, if you really want the best information, best education, and you want to accelerate your knowledge, accelerate the growth of understanding and your personal growth, you got to hire people. You have to hire the experts to teach you. And so we went down that path, and many tens of thousands of dollars later, of educating ourselves. That's really what it took. It really took that for us. And it's, some people say, and I've heard this by educators that I've worked with and respect very much because I know they're excellent traders and they also teach, is when they tell somebody about trading and they give them a strategy and they tell them what not to do and give them guidance on what they should be focusing on. If they give that away for free, the person never follows through. And they could charge $1,000 for the same conversation, and the person that pays $1,000 is going to pay attention. They're going to take notes, and they're going to hold themselves accountable for a period of time because they put money on the line that they're going to take that knowledge and apply it. So that's what happened for us. We spent lots of money, different service providers, and the best education I've ever received was through SMB training, and that's why I stuck with them and really started to develop a relationship there so that I could take that information and kind of help share it with other people and help other people learn the way I did. Hopefully the right way, not spending too much time, trying to consume free information and think that's going to help them grow their trading business.
Yeah, sure. I mean, I have actually heard that in the past, that when you do pay for something, you do tend to, in most cases, pay more attention to it and actually benefit from it more so. I mean, that's probably like a, marketer's favorite phrase as well, but it does actually, it genuinely holds weight in most cases. So that's a good point that you brought up. And you also spoke about, in your answer there, about he spent tens of thousands of dollars on education. I mean, surely no one actually wants to pay that much. In hindsight, how could you have maybe not spent so much on education? Like, how could you have?
I'd say, I could probably go through and pick out 20,000 of that we could have skipped, in hindsight. But you don't know which thousands of dollars and which courses and what instructors and what online programs. In hindsight, we know that some of those, it probably gave us more of the tools and taught us about the market in a way, and by having the cost involved, we really had to absorb it, and that helped us probably at some level. But the parts that mattered, it's probably $3,000 or $4,000 worth of education after knowing the basics that really gave the tools that hard and fast, here's your training wheels, just follow these guidelines, do exactly these steps from day to day. And, most people's personality, most traders' personalities aren't going to be able to live, following a very specific set of rules from day to day. But by starting that way, by doing it that way and letting a system work, you can realize that it's not about your intuition in the market. It really is about strategy. It's really about using things, doing things that make sense, doing things that work. And it's not about your ability to predict. Once you get past that and you stop thinking that the only way you're going to deserve a profit is by predicting, then that kind of frees you of that responsibility, and you know that you can just apply things that work in the right circumstances. So that's probably, tens of thousands is not I'm not going to say that's what it takes. That's not true at all. But I think it does take a few $1,000s of education to at least accelerate your process. Take somebody else's 10 years of experience and pain of developing how it works and let them teach you in a few hours. Let them show you or let them mentor you over a couple of months and just shortcut all of the trial and error and get to what works. Generate profits from it and then go from there and start developing your own ideas. But just trial and error alone that's how it becomes, you're going to be going against the odds for your success, because most people aren't willing to pay for somebody to help them. Most people think you have to predict what the market's going to do to have a profit, and that's just simply not the case.
Sure. Okay. So even for you in the sort of the first few years of your journey, if you had to put it down to maybe one or two things, what would you say were the biggest challenges that you had to push through when you were coming up? So challenges that essentially impacted your P&L in a negative way.
Right. So thinking I have to predict is where it stems from. And then the second part of that is when you're wrong, then you have no plan, because you say, well, I made the prediction. And I really feel in looking back at the early struggles, I really feel like I thought that if I didn't predict it right, I didn't deserve to change my mind and then, stop losing money. Like, I had to take that pain from being wrong, and I had to wait until the market agreed with me to get out of the position. And that was probably the worst and most stressful times, where I went through a few different mouses where they'd get smashed and I have to go get another one and all that stuff. But now, knowing that it has nothing to do with predicting, and I don't have to feel like I earned a profit by guessing what was going to happen correctly, that now it's more about adapting to what's going on and knowing the two different probabilities in every market, which is the trend and the range. If the trend is identified, then you can expect continuation in that trend. However, you have to respect the range as well. So if you're a little bit overbought in a bullish trend, you can't just say I have to be bullish because it's bullish. You can either be flat or a little bit less long, or maybe even a tiny bit short if you want. But really getting past thinking, well, we're overbought, the market has to go down, and that's the only way I'm going to make a profit this week. That there's a lot more ways to do that. So I want to make sure I answer the question fully. Early struggles, is that kind of what we're getting at?
Absolutely, yeah.
Challenges. So thinking I had to predict, not being willing to admit when I was wrong and get in the right direction again. Poor strategies, the wrong strategies on the wrong instruments. That's a big one. So frequently managed income trading styles on low-priced ETFs, that's just a recipe for disaster. So, if you have an iron condor or a butterfly management strategy and you trade that on an ETF and you hear people talk about fixing and adjusting and managing their profiles, you say, okay, I get it. I'm going to use ETFs and I'm going to use an income strategy and I'm going to manage it frequently to make sure I keep it under control and wait till I trap the market. Well, you got two things right and one thing wrong. And the one thing wrong is you're using it on the wrong instrument, which means your commissions are going to be 1,000% more, give or take, whatever the exact number is. But you're spending 10 times as much on commissions for frequent management, which means you're running uphill with the wind in your face because you have to overcome very expensive commissions on that strategy. Whereas the same strategy on an index option has a better chance because your commissions are less. Or contrarian trading without risk management. That's, it's a, public, your show's heard by a lot of people, so I won't mention any names, but receiving guidance from people that were really more in the entertainment business than the trading business, that just expressing their opinions all the time and saying, I have the experience, I've done this for so long, and the market has to go down. And so it's just be short. That's it. That's the whole strategy. Is be short because the market has to go down. And when it doesn't go down, they're silent. They have nothing, no more guidance for you. And you're left to say, well, what am I supposed to do? And if you don't have the right strategy and you don't have somebody that is showing you whether or not they were even in that position, then you're left on your own. Now you're out there with, frustrated and you're waiting until you're right. So, being in the right strategies, having people that are actually showing you that they're doing what they're saying they think is going to happen, and giving you guidance as far as day to day, how to get out of it and what to do if things don't go the way they think. The best traders I know, I'm not saying they're the best traders in the world, but the best traders that I know at SMB, none of them think that they are going to be right. That's just it. That's all there is to it. They have an idea and they have a belief that they are skilled and have a good knowledge of the markets and that they're going to be right more than half the time. And really, it's going to be a number quite bigger than half of the time. But it's still, when they're wrong, they know it's like, I'm wrong. I'm done. I'm out of that one. And it doesn't mean I'm flipping my position. It means I'm wrong and I'm done. I'm out of that one. And you keep the loss small and you move on to the next one where when you're right, you can have the big win. So it's just some of those kind of psychological things and strategic things where there's so many ways to approach the market that if you just have the wrong combination, you're going to be struggling. So just having the right combination of strategies and psychology to make sure that you have the ability to control your losses when you're wrong and, have the good sized wins when you're right.
Sure. Okay. No, that's a really great answer, Andrew. And something I'd like to go into a little bit deeper on what you mentioned there. And it comes up now and then is why you shouldn't predict, you shouldn't try and predict the market. But I mean, no one knows what the next one or X number of bars on the right-hand side of their chart are going to be. So what do you mean by you shouldn't try to predict? Because obviously when you execute an order, you're either anticipating that it's going to go up or it's going to go down, and hopefully in your favor, either direction. Could you just expand on that, the reasoning on and the mindset of predicting?
Sure. And this is going to get into just semantics, but hopefully that by going through that, maybe the psychology will come through. If you feel like you're constantly predicting, or if it sounds like predicting, like the market's currently wrong and it has to do this, or this announcement's going to come out and this is what's going to happen. And you basically position yourself with one scenario. If I'm right, I'll be profitable. If I'm wrong, I will lose. If that's the case, then you're going to, especially, and some people don't even go as far to say if I'm wrong, because they just don't think it's possible. They say there's just no logical way that I'm wrong about this, and this is what has to happen, and I have to be in that direction because it's the only thing that makes sense, and they go for it. And if it doesn't work out, it's like their world falls apart, and they freeze. It doesn't make any sense why it didn't happen the way they thought. Then they have no plan of what to do after that. Now we'll go into the part where you're saying you do have to have some kind of bias. You do have to make some kind of assumption about what's going to happen. Well, in options trading, you don't have to make that distinction. You literally can have no directional opinion in options trading and go from that point. Your only opinion may be whether or not volatility will expand or contract in the short term. But even that is not going to be, that's only going to impact in the short term, but not the trade itself. So that's one way that you can remove predictions. And I found that options traders that find good guidance and have discipline have a higher probability of success than directional traders. And that's just from my own personal experience. I don't have some kind of deep, 1,000 person survey to prove that or anything. But my observation and working with a lot of traders and seeing the success rate with the types of traders and seeing traders that failed at directional trading and then learned about non-directional options trading, that they have number one, they have a great chance that they will stop losing money if they have good guidance on the types of strategies and instruments to trade. And then secondly, they have an increased chance of generating some type of positive results by using a systematic non-directional options trade and with the right management strategies. And that's not saying that they're going to make money every month, but if they stick with it for 6 months, in most market conditions, they're going to come out ahead by following those strategies. And they're not going to be home runs, and you're not going to, triple your account this year, but you can make decent income on a decent sized account. So now I'm going to finish the thought process by saying, now when you do a directional trader, where does that leave them? They are a directional trader, and I said that they can't predict, but they have to have an assumption. The psychology that I would encourage, rather than feeling like a prediction, I would rather have a series of if-then scenarios and several of them. So I would say, if we trade back to this level, then I would consider that a great long opportunity, because it would be a dip in the direction of the trend. Just very simple if-then scenario. If we were to have a dip in the direction of the trend to this level, I think the risk reward would be favorable for a directional trade back to the top of the range, or to a new breakout, and then I would close it when everybody else is buying the breakout. So that's my if-then scenario. Say, well, I don't have to that's not the only way I could make profits on that instrument. I can have a second if-then scenario. If we don't pull back and we break out and we hold, then I can buy a held bid above that level, or if we consolidate above that level for 5 or 6 bars and the bars are getting smaller, then I would also consider that a long opportunity. I don't need the market to come down to my level. I can take advantage of it another way. And I've eliminated predicting what is going to happen. I've given myself 2 ways to profit. I can say if the first one happens and I buy it and then it breaks the level that I thought was going to hold, now I can have a whole nother series of if-then scenarios. If it holds below that and consolidates, now it's a short opportunity. If it trades back above and consolidates, it's a long opportunity. If it trades back above and takes off, I'm going to skip it. It's not trading in a way that I want to trade, and I'm just going to go on to something else. Those are a number of scenarios where you say, in this scenario, I'm going to have a small loss. In this scenario, I might change my mind and go the other direction. In this scenario, I have a lower probability trade, but I might be able to hold it longer. And you give yourself a number of ways to be in that without needing to say, get in some chat room or get on Twitter and say, XYZ is going to drop 50 cents and I'm going to buy it and it's going to make a new high. And now, because you've made some public proclamation, you feel like that has to happen for you to have any dignity in the world. Rather than that, just say, here's some if-then scenarios. If it gets here, I would try this. And it's a more humble attitude. It's a more adaptive attitude. And you don't feel like you have your pride tied up in what happens next in that stock or ETF or index or anything else.
Yeah, that's really good. I like the idea of the if-then scenario. That's definitely a way to overcome that predicting kind of mindset for sure. And just before we get into a few more of the specifics about how you trade these days, I'd just like to ask you, from the point you started to the point where you reached some sort of level of consistent profitability, what sort of time frame was that period?
There was probably a year and a half that was heavy bleeding and painful and stressful. And then probably a 6-month period of kind of turning away from that. And then, what year is it now? 7 years. So, and then after that, just kind of slowly, and it's been a progressively steeper incline from that. So call it a year and a half of kind of poor results and non-results. And then until I was moving into something that was more sustainable. And then now at this point where, achieving levels as an active trader that you don't hear about in the news and from hedge funds and things like that, just because it's more active and for smaller accounts than these big institutions.
Sure. Okay. No, that's really good. And during that time, the first 18 months, how active were you trading and how intensively were you studying?
My study was off the charts. Every waking moment that I had, I was reading and studying and back testing and creating charts and creating studies, just going through and watching webinars and reading books and reading information. It really was, 6 a.m. to midnight every day. It was like, that's all I lived and breathed was the markets. And that's just what I felt like I had to do. And I learned a lot in that process, but I was also not consuming the correct information. So I had information overload from bad sources. So from all of that free information that was out there from entertainers rather than, traders that were actually trading professionally and getting real results and sharing their results that they were getting. I don't think that's the process everybody should go through. I think I worked too hard and looked in all the wrong places, and was looking for people that were going to show me how to predict the market or depending on them to predict it and feeling like I could follow blindly along with them. That just, none of that worked out very well. The study was very intensive and the activity was pretty active, probably 5 to 15 trades a day, sometimes more than that, which would have been a bad thing because I would not have been trading strategically. So moderate amount of trading. I wasn't trying to scalp or day trade or find the hot stock of the day or anything like that. I was just probably over managing options trades in the wrong instruments. The commissions were through the roof, really eating into any chance I would have had of making profit, even if I knew what I was doing. All those mistakes, that's kind of what it looked like. So while I was working hard and feeling like the harder I worked, the worse it got. And so at some point I kind of backed off and said, I'm looking around, and as I was getting into the SMB world and I started seeing these traders that had full-time careers and were basically bought 3 courses and learned for a few months, that they got to the point of profitability. I said, well, what's going on here? These guys, they trade like 3 times a week and, then they're doing well. I don't understand this. So that's when I kind of adapted that mentality and got into a little bit calmer state and learning how to trade that way, and it was doing well.
Okay, sure. And just real quick before we move on, while you're studying from say 6 a.m. till midnight most days, you obviously didn't have a job during that period. So what were you doing for an income?
So that was with the group. I was doing some other consulting, and because my background is marketing, so I would do marketing consulting. I did some real estate consulting, and I had some real estate deals that were left over from the brokerage company because commercial real estate deals specifically, a lot of them take, 6 months, 18 months to happen. So I had a lot of deals that were kind of pending that I still had a commission coming on. So those checks were coming on occasion. So it was enough. It was pretty thin, though. There wasn't really a lot of income, and there was more nights where I was buying ramen noodles and keeping things nice and easy. But thankfully, those days are behind, at least for now. I'm thankful for it, but it's not like that anymore. But I think more importantly, I'm grateful for. I don't even care about what a little extra money coming in does. Mike Bellafiore says he talks to young traders and developing traders and says, what do you think the greatest part of trading is? Why do you think we do this? And they say, the money. And they try to come up with like a deeper answer because they know that's what he's getting at. So like financial freedom and taking care of your family and things like that. He's like, yes, all of that's good. All of that's great. But you could do that anything. You could go out and get a master's degree and be an engineer and do something else. You could get all of that in some other job and industry. So why is it trading though? Why is it trading? And like, it's freedom and you can make more money and this and that. And Mike, he lets them go on and give all their answers, and he's very consistent in his responses. This is something where it's very challenging and most people don't make it. So when you can achieve and you can get to that point where you say, I went through the rigors and I went through that process and the learning process, and now I can actually do it. And there's that achievement level. It's more of an analogy for a professional athlete that has to work hard to get to a certain level. And, some people call it, you can almost call it like the gamification or the sport of it. That's the part that I'm really enjoying right now, is that confidence. That's something I used to look at and have no clue and used to kind of pound back on me and was challenging. Now I can navigate it from day to day and actually feel like I'm on the right side of things. And it took a long time to get there, but I really enjoy that.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, Andrew, so let's move it along a little bit and shift into some discussion about more about the way in which you trade nowadays. So how would you define your trading method?
The core positions that I'm in are income oriented, and income some kind of has a connotation that it's lower returns, and it can be. You're definitely not going to hit big home runs, but it's definitely better than typical investment returns. But income oriented, market neutral trading of options on the indexes. So that is the core position. Probably, I'm just going to think about the numbers and try to do quick math in my head. Probably 80% of the portfolio is in that style of trading, and then the rest is semi-directional. Still has an income approach. Often, probably 90 to 95% of my trades are options, a combination of buying and selling, net short, net long, mostly short options, and then a little bit of futures trading for hedging and for opportunistic swing trades, and a little bit of just more recently in the last few months actually been diving deeper into the SMB equities programs. They have a program now called Trader 90 that's where they have all their tools combined, multiple meetings throughout the day talking about equity directional setups. So I've been getting into more of that since the income trading is going well and want to diversify further. But with the income trading, that's oriented to selling market premium in the options market. You have the edge of time decay, which is the one component to options trading that kind of allows you to trade with the wind at your back. If you believe in trend following, you can believe in the trend following of premium decay, which is that it's a constant in the market, and then you just have to mitigate the other risks in that trading. And that's where I orient a lot of my trading to, and that is a probably a steeper learning curve to understand initially, but ultimately when you get through that, a little bit longer learning curve of how those different aspects work together. Options trading is very much 3- and 4-dimensional rather than directional trading, which is 2-dimensional. You can always call it 3-dimensional. You have up, down, and then over time. With options trading, you have volatility and implied volatility considerations and different Greek measurements and things like that. But once you get through that learning curve, then options allows you to have a higher probability of success as you trade from day to day and month to month. So that is basically the style I'm in. I do sell a lot of weekly premium. That took a long time to master because it is a very volatile market. So I do not recommend you hop 2 feet first into the weekly options market without a lot of experience in trading, probably starting with monthlies. Prefer liquid instruments that I can manage actively, but making sure I get enough premium. So there's a lot of criteria involved in making sure you find the right opportunities in the weekly selling market. With individual stocks, I buy options because they are a little bit more erratic and can move faster and further than an index. So I like to buy weeklies on individual stocks based on the defined trend, pullbacks in the trend, consolidations within a trend, things like that. So that's kind of the mix that I have going on right now, but mostly that monthly contracts, index, options trading right now.
Okay, sure. So if you could, for those who might have no idea about the income aspect of options trading, how would you sort of just describe that and just explain that to someone?
Actually, it's good timing you asked me that, because just earlier today I was talking to Seth and then a gentleman, Mike Eisner at SMB. We had a conference call and we were discussing that exact topic, because we want to bring some of our newer options programs that are really based on very, I'm going to call them simple strategies, and it's not because they have a lower probability of success or any other factor that makes them less attractive. They're just simple to understand. And we were just discussing on how do you describe this to somebody that doesn't know the options market. And the idea is there's the options market is an insurance market, if you look at the fundamentals of it. And I'll just describe it also by paralleling the futures market. The futures market is originally designed, and the purpose of it is for hedging. So if you own a bunch of stocks and you want to short-term lock in the price of those stocks, but you don't want to, say you have a basket of 100 stocks, and they're all different places, and let's say this is back in the old days when they were actually stock certificates, and it was a big to-do to go figure out how to sell all your stock because you thought the market was due for a correction, it was crashing, maybe it was up a lot, so you want to hedge. Whatever that circumstance is, the process of selling was so cumbersome that it was easier to go to the futures market and sell a few futures contracts and have a synthetic hedge. You synthetically reduce your exposure to directional conditions in the market. The options market comes a step further and uses a variety of contracts, calls and puts, that you can buy or sell, and then combinations of those. And it basically creates that same hedging opportunity. You can sell calls, which would limit your upside, but it says if the stock or index rises above this price at or before expiration, then I would have the obligation to dispose of this asset at that price to the person that bought the call from me. And then if you buy the put, or if you sell a put, if the market drops below the put contract at or before expiration, then you could be under the obligation to buy the stock or asset at that price from the person that bought the put from you. So, and then you can be on the other end, you can buy. So you'd have the right to execute that contract, but you wouldn't be obligated to do that. So once you get past, that's where the learning curve is. You have to get all of these contracts and long and short puts and calls, premium, buying premium versus selling premium. Once you get through all that, the simpler analogy is it's just like an insurance company. There's the insurer, and then there's the insured. The insurance company is selling insurance premium. They are the ones taking on an outsized risk for something that is not necessarily likely to happen. And they do it in the right amount of size, and they do it in a diversified way that they have an edge and they have a good business model. And in fact, as the insurance buyer, you hope they do. You hope they have the capability to fulfill their obligations because you need to be protected in your specific circumstance. So maybe a trader, maybe a highly leveraged investor can own a lot of shares of certain companies that they feel strongly about fundamentally on the long side. However, earnings announcements are coming up, or there's just maybe they have a nice profits kind of run away from the mean in their favor, and they want to defend the position, but fundamentally have no reason to sell it. So they can go to the options market and buy puts. And they can put a floor on how much risk they have. And that floor is not a stop loss. The stop loss If it touches that price, you're out. It's done. Your stock is taken away from you. The position is closed, and if it immediately spikes back up in your direction, you're out of the position. You've lost it. So your way of defining risk is a limited opportunity, because if it touches that point any time while the trade is open, you're out of the stock. But if you buy a put, you can own the right to sell it at that price, but you don't have to sell it at that price until expiration. And at expiration, you can either exercise your right, or you can roll the contract, meaning you close that month because it's expiring and you go buy a put in a different month. And that's a way to defend your position without using a stop loss. And it's very common to do that because it adds a little more flexibility. Now, all the benefits of that, the other side of the coin is that happens at a premium. You have to pay a premium value. When you study, it's called extrinsic value. It's called options premium. In that, it's just like insurance premium. You have to pay for the right to be covered. And so you pay that extra value. So if you don't use it, that premium goes away. It goes to zero at expiration. So if you buy a 1 month put, it expires a month from now, and you pay $1 per share for that put for a $150 stock, you're going to lose 0.75% on that stock value to defend that position. But if it drops 20% overnight, you're going to lock in, you're going to minimize, and you're going to reduce your exposure. Say the put you bought was 5% below the stock price, and it opens up down 20%. You are capped. You do not lose more than 5% plus the cost of the put. So you would lose 5.75% instead of 20%. And that's the purpose of the options market. Now, if you go in and you are an options seller and you know how to combine various options positions and hedge those, you can actually bet in both directions of the market at the same time, and you have the middle of that position, which is premium decay in both directions, where you either own puts and sell more premium below it, or you can sell calls and sell puts. That increases your odds because usually an options buyer is going to buy in one direction or the other. But if you bought in both directions, you'd be over-insuring, statistically speaking. So you'd have too much premium paid. Well, if you go as a seller, you want to sell too much. You want to sell more than is probably going to be needed to insure those positions. And then you use other management techniques, management from day to day. You can look at your risk and make adjustments when things are changing, or if volatility gets to a certain level, you reduce your exposure. There's a lot of management techniques beyond that. And you can see that from there, it's entirely different. It's a completely different market than stock trading, where you just have a variety of setups that have a probability of either going up or going down. And then that's your directional exposure. It's a very 50-50. When you look over 1,000 trades and 1,000 traders, it's a 50-50 game. Whereas a trader with excellent experience and guidance and using a good system or good strategy is going to be better than 50%. An options trader can pretty much day one with a good system can become 60 or 70% profitable. And they can use management techniques that keep their risk reward very favorable as well. But you have to get through that learning curve of how the options market works. And without the proper learning curve, you have a lot going against you, because there is an outsized risk involved in the options market that the brokers, the market allows you to take amounts of risk that they would not allow you to take on a pure stock trade. So that's a risk that has to be understood and has to be studied very well, or else you could be walking into a lot of pain in the options market.
Okay, that's excellent, Andrew. Thanks for really expanding on that. That's excellent. So while options are, of course, your weapon of choice, the way in which you trade options, I believe, is fairly systematic. So if you could describe to us what extent is your approach systematic, and are there still any discretionary aspects to this?
I worked for a very long time to develop systems through a combination of underlying market statistics and signals for both the trend as well as mean reversion. And then I also did a lot of systematic study of option strategies, so different management techniques, selling different strikes with different times to expiration, different frequency of management, different ways of looking at directional risk and hedging that from day to day. And my first experience with SMB was as a student, and I was actually taking a course. I'm going to call it a course, but at the time I took it was not a course. It was actually, I asked them, I called up and I talked to Steve Spencer, co-founder, and I said, is anybody there? Could they train me on developing trading algorithms? And he said, let me get back with you. So, and then he got back with me and said, we have an algorithm trader here. He develops systems, and he is developing systems and signals and indicators for the firm, and he would be willing to do a training. So I actually went up to SMB, and this is part of where my, that adding up to my, a little bit more expensive learning experience than most traders go through. But I think it was 10 days I actually spent there the first time on the desk working with Rick Martin, their algorithm and systems trader and trading developer. And that's where I started to learn a lot about the systematic approaches, very rule-based, combining a lot of the tools that you see. So if you see an indicator and you see a system, you can actually just take all of that information and combine it into one set of rules and automate a backtest, automate a report that would tell you how well that would do and what the statistics behind it were. And there are some very excellent algorithms and systems out there. To me, there's a lot of systems that you can develop a back test that has extremely great results, high probabilities of the historic trades working out, excellent equity curves, low drawdowns, big run-ups, doing very well. But when you dig down and you either randomize the information or you move it into the forward market, a lot of those systems break down and don't work. So as far as high probability trading, to be able to develop a fully automated directional system, to me it's just not my psychology. I spent a lot of time working on that, and I got a lot of benefits from it that I'll talk about in a second. But just as far as the study of it and applying it, to answer your question, do I use discretion? Discretion is a huge part of my execution trading and my trading decisions. I use systems to guide what I look at. I get signals and alerts on things that are worth trading for a variety of reasons, either pullbacks in the direction of the trend, liquidity, relative implied volatility, things like that, relative strength to the market, a lot of those things, general trendiness signals, consolidation signals on all instruments that I really like that work well and continue from back testing statistics all the way into taking those signals as a discretionary trade, seeing that the wind is really at my back. The trades get easier, the profits are more easy. I don't have to wonder about what's going to happen in the trade. I just know I have a good probability. I put the trade on. I have a reason to exit. I have a reason to take profit, and that's it. So on systems, I believe that studying systematic trading is very valuable. It's actually very valuable for an investor, somebody that's looking for much longer-term holds using a systematic approach. Maybe it could even be a fundamental way of looking at the market and picking a portfolio. There's still a systematic way that Rick taught me, and then together, actually, a couple years later, we then developed a course together to kind of formalize that experience that I went through, which was kind of off the cuff, scheduled. He designed it. We got together and we had a 10-day one-on-one experience to study and learn all of this. And I got to absorb his decades of experience on Wall Street and in Chicago and absorb all that information, processed it, stayed in communication, developed a lot of systems, did a lot of correspondence and work together, phone calls, went back and visited, and then ultimately it came down to saying, let's formalize this, make it a more of a video series that's a little easier to intake, more affordable because it's recorded. So we put that together. And in that, we actually, in that course, we had a couple-minute period that we talked about what we call the 7 steps to system success, which is whether it's a discretionary, really you can use it to analyze your own discretionary trading is one thing you can do with it. So you're basically analyzing yourself as the system, or you can analyze an indicator. You can analyze a management technique, a filtering system. Say if a filter generates that this is a stock we're trading for the day, and you can just see what the ending result for that day would be on each of those. But whatever it came out to be, these 7 steps are very useful for kind of measuring any type of trading, any style of trading.
Yeah, okay. So those 7 steps which you just mentioned there, I've actually seen that video series and it was really well done. So would it be possible to ask you to briefly run through those 7 steps, just mentioning what each one is, along with just 1 or 2 real quick points?
Yes, got it. The first, there's those 7 steps, and we have them in a specific order. And one of the first things I like to mention is when looking at this, and you can do this for a lot of any type of education, when somebody's giving you a list or a bullet point or a summary, you can say, why isn't something in this? And in this circumstance, I always like to point out the fact that the one that we have listed last is last for a reason. And it's without fail. Any system I talk about, one of the most common questions at the very beginning is accuracy. It actually, just today, we have the Options Tribe premium chat room. And the question came up today. We're talking about ratio straddles, where I sell premium at a ratio. So I have a directional opinion, but I also have a market neutral opinion, premium decay, stop losses, automated management, things like that. They're saying the first question, we're kind of bringing up that conversation again, and one of the first questions that got popped in was, and I'll kind of leave some suspense, I won't even tell you, but it was this last point. It's the without fail, it's so common to see the first question be asked is what we feel is one of the least important things to be concerned with in trading. So there's your suspense. So I'll save it for the end. The first one is risk. That is absolutely the first and most important thing. The first is the one at the end, but one of the top ones that's often discussed is what's the return? How much did it make? How much did it make last year? What's the average annual return? How much did it make per week? That's often the first question, is how much did it make? But we like to look at what is the risk? And there's multiple forms of risk. And the series is free. If you go to SMB training, or actually I think you can just Google it. If you just type in 7 steps to system success, it probably, or you can, you're going to link to it probably.
I'll put a link to it in the show notes.
There you go.
So if anyone wants a link, it'll just be at chatwithtraders.com/28. And the link will be just below the interview. So
yeah, that'll be good. Yeah. You can go through that and see. But risk, we talk about total capital required to make the trade, average drawdown, average loss, cumulative drawdown, so that's a peak to trough measurement, looking at standard deviation of a loss. A lot of those types of measures, that's most important, because if you have 2 systems that both make 60% a year on average, and one has 5% drawdowns and the other one has 15% drawdowns. And I have actually a couple more examples where it even goes to the point of showing a system that made less but had a better ratio of drawdowns. When you apply leverage to that, or you randomize that information and you take the same statistics and you repeat it randomly through a program, it actually shows you that it's unreliable or it's less reliable. And when that happens, it means that's something you can't scale up. Nobody's trading because they want to make another $1,000 a month. Everybody that's ever gotten into trading, no matter how small they start, it's without fail. If you know how to do it, you're going to open up an Excel sheet and you're going to do some kind of compounding interest calculation to figure out how quickly you're going to be able to trade bigger so you can make more. And if you don't fully know and understand risk as a mathematical figure in your trading, all of those dreams of compound interest are going to turn into nightmares because you don't understand the big drawdown that's coming. And you have a couple of good weeks or a couple of good months, so then you ramp up your size, and you don't know when that risk that you could have defined by your strategy, that it was going to hit you down too far. So you shouldn't have ramped up so quickly. You should have ramped up a little slower, considering the risk that was probably coming. They do this at SMB on the options desk. They're doing very well. The market's been excellent for market neutral options trading. But the reality is, their flash crash is coming. A 2008 is coming. And August 2011 is coming, and which are the harder times. And there's going to be a drawdown month. So they're always taking that into consideration on their trade size, not just ramping up the next month because last month was good. They know the pending risk. They know what's going to happen. And so that's how you pick your trade size and how big you're going to trade and what your expectation is. The second one is reward. You do have to have a positive belief and a positive mathematical and statistical outlook that you're going to have trading profits. So, and they need to be proven by looking back in time at what you've been doing, and they need to be proven in a simulated environment, and they need to be proven forward in the real world. And if you're not getting a reward, if there's not profits, you need to really, don't let psychology say, well, eventually it's going to start working, or I'm going to start tweaking things that I've never considered before and think that's going to make the difference. You have to have a positive expectation of profits. The third one is actually the term expectancy. So I kind of said expectation, but expectancy is an actual math formula that's used for your average win, your average loss times the number of each of those. And that comes down to an expectancy number. It's a very simple calculation that we could almost put this as, I can almost move this up to number one because it's such a valuable number, and there's so many other figures that systematic traders use as far as cumulative average returns, Sharpe ratio, standard deviation of returns, etc. Cumulative or expectancy is a simpler and very straightforward figure that also has the benefit where when you have a single trade on, while that trade is on, it's very, very difficult to think about the fact that this is 1 out of 1,000 trades. There's going to be 1,000 entries and exits that you're going to experience on a system or through some approach to the market. And when you look at each trade as if whether or not this one works out, or whether if 60% of the next 10 trades or 80% of the next 10 trades work, that has some kind of weight on the system. When the reality is it's over 1,000, you need to know that every time you pull the trigger, that you're not going to achieve a specific return that is your expectancy number, but you need to psychologically say, as long as I do this right, as long as I follow my rules, as long as I do what I'm supposed to do with this trade, I need to just know that I'm racking up my expectancy number. That every time I do it right, I just say, I earned $23 on this trade because that's my expectancy in this system. Whether or not you lost 10 or you made 60, it doesn't matter. You say my expectancy is $23 per trade, and that's the psychology you have behind using expectancy rather than how often you're right. The fourth one is volatility, which is not necessarily the volatility of the instrument you trade, but it's actually the volatility of returns. So it's basically it's not simple math, but it is simply proven with math that if you have less volatility of returns, so fewer of your trades are outliers. Most of your profits aren't generated from 1 or 2 big wins, and you don't have these sudden larger losses than usual. When you can eliminate those, you have less outliers, you have a better probability of that system working for years and years to come. So looking at different ways of volatility of returns is something that we do. Which one am I on? 5. 5 is frequency, so that is partially psychology, also has to do with transaction costs, that a higher frequency system, especially as a retail trader, instantly has lower probabilities of success because your ratio of cost to expectancy goes up. So that is one of the things behind frequency. Also, your ability to execute, if you're taking the trades manually, goes down because on paper it looks wonderful. In the real world, you realize that sometimes you're sick, sometimes you go to the bathroom, sometimes the power goes out, and there's a lot of things where you can't mess with your statistics because of the fact that you aren't a machine. The sixth one is duration. So that's a kind of a psychology one that lets you know that some systems, trend-oriented systems specifically, are going to have a lot of losses put together. So they're going to have a lot of small losses with very short duration. So you're going to feel like you take a loss, you take a loss, you take a loss, you take a loss. And then you have a trade that starts to go in your favor. Psychologically, you say, I don't want this one to turn into a loss too, so I'm going to take it off. And that becomes the one that makes 10 times more than any of the losses had. Knowing that there are systems like that. I've seen systems with 30% accuracy or less that were fantastic systems because they had tiny little losses when they're wrong. So they just accumulated a few little losses, but they were great setups. They were the times when they could take that small amount of risk and they get wiggled out. They take the setup occurs again. They take a little risk. They get wiggled out, and then the setup occurs. They load up on the position, and it goes in their favor, and it goes big, and it goes for a long time. So your losses may have been 2-3 hours, and your wins can last 2 weeks and be enormous. So knowing that behind your system lets you know to allow those losses to just happen. Let them accumulate. Let them happen over a short period of time. If the entire market is very stagnant, you may have a lot of stocks, a lot of positions, all experience the same thing at the same time. And right around the time you want to quit and pull the plug, 5 or 6 of those can run in your favor big on that system. So you just have to know what the duration expectancy is. And then the last one, which often is brought up as the most important thing, is the first question I often receive about a system or a strategy that is, I feel, could almost be removed from the list. But there is a purpose for it on the list, so that's why it's still there. And that one is accuracy. Asking how often or how many trades out of 10 or how many trades out of 100 are profitable is probably the most common first question, but it is the least important aspect of trading to know if something is going to be reliable and profitable in the future. The psychology of having to be right is what often brings that up. The psychology of wanting to win often is brought up. The training that we have in school that says if you get if you get less than 70% of the answers right, you are a failure. You have failed at this. And bringing that into the trading world is what keeps a lot of people from becoming profitable and having fun in this market. You have to be willing and understand that you may actually be wrong half the time, and that could lead to excellent results. You could have a 50% success rate and have outstanding results. Because if you're 50% accurate in a trend-following approach to the market, so half of your trends run in your favor and half of them have small exits, you're going to be fantastically successful at trading. The reality is trend following is often 35 to 40% accurate. And that's why most people fall in love with the concept of trend following. But then when they try to execute it, they often get shaken out and move on to something else pretty quickly because they get that negative feedback from the market and see that they're accumulating losses. And instinct comes in and says, well, if I'm not getting the results I expected, it's probably wrong and I need to quit. But the reality is you just didn't have the right expectation of how that was going to work out. You probably were misled into being only shown great examples of when something worked, or being shown 2 things that didn't work and 5 things that did. And that sets you up for that expectation that if you do this, you're going to win more often than when you're wrong. And the reality is, it's probably not that way. It's probably 7 losses and 3 wins, or 6 losses and 4 wins. That's probably how it is. And you may actually enter where you have 10 losses in a row, or 1 out of 10 works. And that's not enough data to consider something invalid. You have to look at more information than that. So those are the 7 steps in a very abbreviated way. The entire video series that you can opt in and get for free explores that over, I think it's either 7 business days or 7 calendar days that you get those. There's a video and kind of an article that goes with each one of those. So you go through that entire process, and even that is just a very brief snapshot of what Rick and I went into in the Systems Foundation course at SMB, where we really dive deep into all these metrics and ways of looking at different techniques and strategies, and how you can measure them and know if they're going to work.
All right, awesome. No, that was really good, Andrew. Thanks for going into so much detail on that. And I'll put the link to that in the show notes at chatwithtraders.com/28. So if anyone's interested in learning more about systematic trading, then definitely check that out. I did, and I got a lot of value from it. So anyway, we should probably start to wind things down, but let me ask you just one more question.
Sure.
And I love to ask this question to a majority of the guests, and that is, what's the number one reason why the majority of traders lose money and never reach a high level of success, in your opinion?
Well, I'll have to just give an answer, because I could probably think about this for days and come up with it, but or I might give a mixed answer. One is, there's traders enter the market with a lot of confidence because they're either smart, so they may be more intelligent than a lot of their peers, family, or friends, and so they look at the trading market and say, okay, most people fail at this. However, I'm generally smarter. I am good head on my shoulders. When I try to understand something, I do well with it. And I'm also passionate about it. So they say, well, I have what it takes, because most of my friends, they're just not even interested. So if they try, they'd probably fail. So I'm probably well suited for success because I have other success in my life. Or I've seen very successful businessmen and investors that in the markets that come to trading, and they get a negative feedback from the market, meaning they lose money. And they approach it the same way they would approach anything else in their life. If it's sports and you're losing, you just practice harder and you try harder and you learn more, and through sheer effort, you're going to be able to improve yourself and get better results. In business, you can work longer hours and you can cut your prices, and you can make decisions that you control how you're going to fix it. And you get positive results from that in other areas of your life because you overcome what's going on and you make it work. And traders, those that are attracted to trading, often have that mentality and characteristic. Then you come to the market, and you have to learn very, very quickly that your willpower has no place in the markets. Your willpower to say, I am going to hang on to this trade until I'm right. I'm going to will this system to work. I'm going to will this trade to work. And you just say, I know I'm going to be right. And you take that approach to the market. The worst thing that can happen is that you get rewarded for that a few times. So you call the top in something that's high flying or up big for the day. You call the top and it drops right away. Say, oh, that's great. I should have taken a bigger size. Then it happens again, and you do it again, a little bigger size, and oh, that was great. And you don't even realize the whole market was consolidating, so every pop was faded. And then all of a sudden, the December rally comes and the market breaks out. You say, well, I've been conditioned. I know it works. I'm going to short this thing. And then it takes off. The whole market goes up 6%. Your stocks go up 11%. And the whole time you're just trying to will it. You're trying to study. You're trying to figure out why it should go down, why it's got to work out, why you're right. And through some willpower effort, it's going to work out for you. Where the mentality that works is to know when you're wrong and have a understanding that certain there's nobody that's going to be right 100% of the time. And as soon as you are wrong, as soon as you get to a point that has exceeded your expectation of what should happen, that you need to do something about it. And one reason I love options trading is I don't always have to close the position. In my psychology, that works great because I still get to kind of hang on to my idea. But in options trading, I can take other approaches for just kind of defending myself and bringing in a different trade to kind of enhance the position and not really close the original one. It's just kind of a psychological game I get to play that helps me, and it really works out better. But I think that's kind of it, is that they bring in success in other areas of their life. They try to apply it to the market, and the market doesn't play by the same rules. So I think I'm just going to pick that one. I think that's kind of one may not be a common one that's brought up.
Yeah, that's actually a really unique answer. I don't think anyone's given anything quite from that angle before, so I really like that answer. That's a good one. Now, Andrew, thanks so much for coming on. Now, I know there's quite a few listeners who I've spoken with who are keen to get into options or who might have already started on options. So would you be open to answering any questions that listeners might have in the comments about trading and more specifically around options?
Yeah, that'd be great. You can just let me know or figure out some way that I can be notified when they get posted, and I'd be happy to answer any questions.
For sure, yeah. So if anyone has any questions for Andrew, just go to chatwithtraders.com/28, scroll to the bottom of the page and just leave a comment there. And I'll let you know, Andrew, whenever there's any new questions there, and you can jump onto those.
Great.
Okay, and where can listeners go to find out more about you?
You can go a lot of places to find out about me, but most of my work right now is through SMB Capital and SMB Training, also known as SMBU. So the fastest way to type that in is probably smbu.com. You can also get me on Twitter. So I have a pretty unique first and last name combination. So if you were to Google Twitter, Andrew Faldy, or just Andrew Faldy in general, you'll probably find me in a few different places. And I don't have any other distant relatives or anything with the same name at this point. So I'm pretty easy to find that way as well. So Twitter, Andrew Faldy, or I think it's Andrew F_SMB, but it's pretty hard to miss. But what's any other way? Andrew at andrewfaldy.com is email address. You can send that as well, so it'll come right to me. And then I can add you to my Google Plus, and you can get updates that way as well.
Okay, good one. Well, I'll make sure to put links to everything you just mentioned there in the show notes, including your Twitter handles. So, anyone who wants to find out more about you can just jump onto any of those links. And like I mentioned, I'll also put a link to the video series that you created about system trading. All right, Andrew. Well, thanks so much for coming on the show today and sharing plenty of valuable pointers with everyone listening. Have an awesome week, and let's stay in touch.
All right. You're welcome. Thanks a lot for having me.
Thanks, Andrew.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be